More mortgage pain could be on the way as the Reserve Bank considers a 13th rate rise in just 15 months today. Live to Trudy McIntosh in Canberra for all the latest. Trudy, what are leading economists expecting?
Well, Pete, same old story here. Economists are not on the same page, but neither are the big banks on whether we'll see a rate rise again today or the Reserve Bank will keep things on hold for this month. We certainly can see the case for a pause. It would give the Reserve Bank time to consider those June quarter inflation numbers. They're not out until much later in the month, and that's the much more reliable indicator. But there's certainly a lot of reasons why the Reserve Bank will hike rates once again. We've got low unemployment. The inflation number remains stubbornly high. Wages are ticking up at a time we're not seeing corresponding productivity growth. The retail numbers show Australians are still spending despite all this mortgage pain. Interest rates have gone up 13 times, as you say, in 15 months. We were at a low of 0.1% in April of last year. Look where we are now at 4.1%. And for households, they're certainly starting to do it tough. If there's another rise today, what we will see is people paying double what they had each month on their mortgage. If you've got a $750,000 mortgage, your repayments are around $5,300 a month, an extra $1,800 compared to where we were last April. The opposition calling on the Labor government to do more to help the Reserve Bank by taking off inflationary pressure.
The Reserve Bank focuses the pain on interest-sensitive, hard-working Australians with a loan, while putting the aspiration of home ownership even further away for young Australians. While the RBA is doing what it must, in Canberra we see indifference, or worse, incompetence.
There are still signs of a very resilient housing market. These figures just out yesterday by the ABS show new loan commitments in the system in May rose by 4.8%. That was well above what the forecast was at about 1.4%. You can see there, Pete, it was at its high in January of 2022, $34 billion. Yes, it dropped back, but it's still ticked up and we're above where we were pre-pandemic. So, yes, we might see a pause today, but the warning is there is more rate pain to come this year.
Yeah, there will at least be another couple of rises, at least somewhere down the track, if not today. That's a good point. Trudy McIntosh, thank you.